All right, so I'm going to open chapter 16, part 1. And chapter 16 is about two different topics. The first half of what we're going to talk about is called dilutive securities. Dilutive securities. So, what does it mean for a security to be dilutive? If you think about something diluted, it means it's watered down. We're not talking diluted. We're not talking someone who has a delusion. We're talking diluted. So, diluted means watered down or made to be less powerful. And with securities, often there is the possibility that our ownership interest may be diluted by additional shares being issued. So, how would this work? So, let's say, for example, that I buy into a company and I buy 1% of the outstanding shares of stock of that company. What I would expect then is I've got 1% of the voting rights, and I would get 1% of the dividends, and I get 1% of the net income would be attributable to me. And so I would assume that I would own 1% of everything. But it's possible that other events could happen that could water down or reduce the percentage that I owned. So, for example, the company could have shares of stock that get issued later during the year that I wasn't expecting to have happen. How could that happen? So, for example, there could be preferred shares that can convert into common shares. So if I buy 1% of the common shares and then somebody else who owns preferred shares converts his preferred shares into common shares, then I don't own 1% of the common shares anymore, even though the cash that I paid doesn't get refunded to me. I've paid for what was 1% at the time, but it could reduce to less than 1%. There could be preferred shares that could convert to common. There could be bonds that could convert to common. Or there could be additional shares that are issued for things like um, compensation plans for executives. We'll talk about those later as something that can dilute securities. So really what we're talking about is a variety of ways in which an owner's ownership percentage can be made to go down by transactions by other people. Now, why does that matter for accounting? Well, it matters for accounting for a couple reasons. First of all, we have to understand how to account for these dilutive securities, how to account for things that could be converted into common stock. And we also need to do this because of the second half of chapter 16, which is about earnings per share. Now, you may have noticed as you've listened to business news and things like that, that dividends, earnings, and prices and a bunch of things are reported on a per share basis. So when companies make their annual or their quarterly earnings reports, they report them on a per share basis. Often they report them in total, but they generally are going to report them in a per share basis as well. And as we report earnings per share, we have to make sure that we understand there are two kinds of earnings per share that get reported. There's the basic earnings per share, and then there's diluted earnings per share. And what that means is the diluted earnings per share is if everything that could be turned into common stock got turned into stock, how much earnings per share would there be? In other words, if everybody who had securities or things that could become common stock during the year, if they did, how much lower would my 1% ownership actually turn out to be, and therefore how much less earnings per share would I get? So we have to understand how to report earnings per share, both undiluted and diluted, and we have to learn how to account for these kinds of transactions. So in this chapter, we're going to talk about 4 different kinds of things that can become common stock. We can talk about convertible debt. We can talk about convertible preferred shares. We can talk about stock warrants, and we can talk about stock options. Convertible debt is bonds that may be converted into common stock, usually during a specified time after issue and a specified conversion rate. So what this means is when somebody issues debt, when a company borrows money and they issue their bonds, sometimes what they do is to say, all right, if you give me, I don't know, $100 million, you can have the bond, you have the promise of future cash flows back to you and the interest and all that. And on top of that, we'll give you the opportunity to buy shares of stock, or sorry, to convert your bond into shares of stock. So if, for example, the company starts doing really, really well, and you want more than just your specified cash flow back, but you actually want the opportunity to participate in the upside, you want to participate in the increase in share price, well, then you'll have the opportunity to convert your bonds into a certain number of shares of common stock. That would make the bond more attractive. It could be a way to get more cash in the short run. If interest rates are too high and you're not going to get a good price on the bond, there might be a way to get more cash, but it comes at a cost. The cost of getting the extra cash, because people want the bond more, is you could potentially dilute your ownership interest for your current shareholders. So how do we treat this? When convertible debt is issued, we're simply going to treat it like we have in Chapter 14. So we're going to calculate the issue price, the par or premium or discount, and we're going to record all the transactions just like we've already done. And if the bonds never get converted, if the bondholders say, nope, we're happy with our cash flow, we're not going to convert it into common shares, then the conversion feature never really gets accounted for. But if it does get accounted for, there are two ways that we can use, and we're going to use the book value approach in this course because that's the one that's most commonly used. It's considered GAAP. You could also use the market value, but we're not going to do that because it's seldom used, and we'll just stick with the book value approach. So what we do with the book value approach is we use the carrying value of the bonds at the conversion date, and we convert that into the book value of the new common stock. So let's take an example. Take a look at an example. Brief exercise 16.2. Petrenko Corporation has outstanding $2,000 bonds, each convertible into 50 shares of $10 par value common stock. The bonds are converted on December 31st, 2017, when the unamortized discount is $30,000 and the market price of the stock is $21 per share. Record the conversion using the book value approach. So as we read our requirement, we're going to use the book value approach. We can actually ignore the market price. That's a bit of unnecessary information. We do need to understand what the book value of the bonds is. So we know there are 2,000 bonds. They're $1,000 each. So the face value is $2 million. We also know there's a discount at the conversion date of $30,000. And so the book value or the carrying value is $1,970,000. So at the time of conversion, we have $1,970,000 of book value. That's the amount of book value that we are going to convert into shares of common stock. So we're going to take our bonds payable off the balance sheet at $2 million. We're going to take our discount off the balance sheet at $30,000. Now, how are we going to put our $1,970,000 onto the balance sheet as equity? Well, how many shares of stock do we have? There are 2,000 bonds, and each one is convertible into 50 shares of common stock. So that's 100,000 shares, and each share has $10 par value. So our total par value of common stock we're going to put on the balance sheet is $1 million. And the additional paid-in capital for the common stock is going to be the difference between the total book value and the par value. So all we've done here is we've taken the bond off the books at the book value for which it is currently recorded. So as of December 31st, 2017, the book value or the carrying value would have been $1,970,000. We no longer have a bond payable, but instead we have common stock. So the common stock is recorded at its par. The paid-in capital is the plug figure, as it generally is. And the bond is reduced. So for exercise 16.2, that demonstrates how simple it is to use the book value approach. You take the bond off at book value and you put the common stock on at book value. All right, so that is converting convertible debt to shares of preferred stock, or sorry, shares of common stock. So we'll jump ahead. And notice no gain or loss is recognized in the book value approach. Our total liabilities go down, our total equity goes up by the same amount, and there's no difference. Convertible preferred stock is pretty much the same thing as convertible debt. Preferred stock, remember, preferred stock often has preferences in terms of getting dividends more quickly. It has preferences in terms of if there's a liquidation, they would get paid back before common shareholders. So they're preferred in that sense. They also generally don't have voting rights. That's kind of the trade-off that you get when you buy preferred stock. But preferred stock may also be convertible to common stock at a predetermined rate. Again, as a way to issue common stock that's more, as a way to issue preferred stock that's more attractive, we might say, here's the preferred stock. If you want to convert it into common, you have the opportunity to do so. Now, why might you do that? Why might you give up your preference for distributions and dividends? You may find that the company is going in a direction that you're not a big fan of, and you want to turn your preference into voting rights, and you say, hey, look, if I can make some better voting decisions, I might be able to influence the direction of this company, and that will help me make a better profit. So this is often done in venture capital kind of settings or sort of small business funding kind of settings, where you've got somebody whose initial job is just to provide capital, like a venture capitalist, but if things start to go south, that person or that firm wants to be able to exercise authority and protect its investment. That's something that I saw with my client that was a venture capitalist. They had a lot of convertible preferred stock. So again, we're going to issue it the same way we issue shares of stock in Chapter 15. And again, for the conversion, we're going to use the book value approach. The carrying value of the preferred stock is going to be the assumed issue price of the common stock. So again, we're going to take the preferred off at book value and put the common stock on at the same total value. So let's take a look at, brief exercise 16.3. Pechstein Corporation issued 2,000 shares of $10 par common upon conversion of 1,000 shares of $50 par preferred stock. So they had some preferred stock outstanding, 1,000 shares of $50 par preferred, and then it got converted into 2,000 shares of $10 par. So the 1,000 got converted to 2,000. So it was a 2-for-1 conversion, and the shares have a par value of 10 for the common, but the preferred had a par value of 50. The preferred stock was originally issued at 60 per share. We need that to know how much paid in capital there was for the preferred shares. The common stock is trading at 26 per share at the time of conversion. Record the conversion of the preferred stock. Again, if we're using the book value approach, we don't need to worry about the market value of the shares. So what do we need to do here? We need to take our preferred shares off the books. And it's recorded at par, so that's going to be 1,000 shares of 50, so that'll be $50,000. We're also going to take the additional paid in capital for the preferred off the books, and that's going to be 60 minus 50 $10 per share at 1,000 shares. And yes, I can do the math in my head. I'm just trying to leave a rabbit trail here. So we're going to debit our preferred stock and debit our additional paid in capital and take those off the books. And then we've got to do the same as we normally do for common stock. are we going to put common stock on the books? We're going to put it on at par, and that's going to be 2,000 shares of $10 par stock. So our common stock goes on the books at $20,000. And then our paid in capital is going to be the plug that we need to make our journal entry balance. So here's our journal entry. We're going to debit preferred stock 50,000, take it off the book par as it was originally recorded. Additional paid in capital, take that $10,000 plug off the books as it was originally recorded. Put the common stock on at its par value, and put the additional value that's being converted into common stock on as additional paid in capital. All right, so that is the recording of both debt and preferred stock as par value. All right, so what comes next? Again, no gain or loss is recognized. Stock warrants. So stock warrants are certificates that give people a right to acquire shares of stock. They're typically issued with other securities, again, in order to make the instrument more attractive to investors. Now, warrants are not the same thing as conversion. A conversion, you would lose your debt. If you converted debt, you would no longer have the debt, but you would exchange that for shares of stock. A stock warrant, if you exercise your warrant or you use your warrant to purchase a stock, you keep your debt and you have the new stock that you issue with the warrants, or that you purchase with the warrants separately. So warrants increase the total number of securities that you hold versus a conversion, which is an exchange. There are two types of stock warrants that companies generally issue. One is detachable and the other is non-detachable. A detachable warrant is one that can trade separately. So if you buy a company's bonds and you get the warrants attached to it, you can sell those to somebody else. They can trade like their own security. Non-detachable warrants are not allowed to be traded separately. So the only people who would have the opportunity to buy those warrants or to buy those shares of stock with the warrants would be the original bondholders themselves. And again, these things are often going to be done in private sort of financing to make sure that those who are providing funding have the opportunity to exercise additional control for a privately held company. For detachable stock warrants, the warrants and the debt are accounted for separately. And we want to separate the issue price into the debt portion, which is the bond and any related premium discount like we've always done. But there's also a portion of the cash that we raise that's equity. And that's going to be a paid in capital from stock warrants. This is going to be a situation where we've got paid in capital relating to something, but we don't have the stock warrants themselves on the books as an equity. We've just got the paid in capital related to them. And of course, there are, as you might expect, two methods to allocate the purchase price. So the issue price, if someone buys a bond, they're going to get the bond with the warrants, but it's going to be priced as one big lump sum. How do we allocate the cost or the purchase price the proceeds? Having trouble with words today, I'm sorry. How do we allocate the issue price or the proceeds to both the debt and the warrants? And our two methods are the proportional method, which is based on the relative fair values, or the incremental method. Again, this is something like we did in the last chapter, in chapter 15. If we issue common and preferred together, we had two different ways to allocate the cost. So this is fairly standard accounting practice. When we have a market value for both the bond and the stock warrant, then we would be able to use the proportional method, or you're using the relative fair market value. When only one of those securities has a market value, it could either be the warrant or it could be the bond. When only one of those has a market value, we would assign the market value to that one, and whatever's left over, the increment that's left over, would be attached to the other security. Again, similar to what we did in Chapter 15. Now that's only for detachable warrants that would trade separately from the bond security. For non-detachable warrants, they are issued with the debt, but they can't be separated from the debt, and no value is placed on those because there's no means for the person who's bought the debt to trade them separately. So from an accounting standpoint, we ignore the detachable warrant. So let's take a look at brief exercise 4 and demonstrate how we would use one of the methods to record warrants. Eisler Corporation issued $2,000 bonds at 101. Each bond was issued with one detachable stock warrant. After issuance, the bonds were selling in the market at 98, and the warrants had a market price of 40. Use the proportional method to record the issuance of the bonds and the warrants. So what we have here is a situation where we've got two separate securities, the bond and the warrant, and we have a market price for both of them. So we have the opportunity to use the proportional method. We have information about both market values. So we're going to include that. So what we want to do is we want to take the separate market prices that exist and use those to allocate the initial purchase price. All right, so that's what we're going to do. We're not going to use the initial 101 because the 101 already includes both prices. We want to use the separate prices. So the bonds, we have 2,000 bonds at $1,000 a piece, and they were trading at 98. So the market value of the debt without the warrants is $1,960,000. The warrants, each bond has one warrant, so there are 2,000 warrants, and they were trading at 40. Don't want that. And they were trading at 100% of their value. So the total value that was trading in the market was $2,040,000. Excuse me. That's the total amount of market value that was had. The issue price was not $2,040,000. The issue price is only $2,020,000 because the $2 million worth of bonds were issued at 101. So the question is, how do we take the $2,020,000 that we received and split that $2,020,000 over the two types of securities? Well, if we have information for both of them, we're going to use our relative fair market value approach. And we're going to recognize that the bonds had about 96.07, so about 96% of the market value of the two securities together. And the warrants had about 3, almost 4% of the value of the two securities together. So we're going to take those two percentages and we're going to multiply those by the total issue price. And if we say that 96% of the total value goes to the bonds and the total value that we have allocated is $2,000,000, then $1,940,784 is the amount of value that's going to be allocated to the bonds, and the warrants are going to be recorded, or the paid in capital for the warrants is going to be recorded at 79,216. So now we got some pieces parts. We got to figure out what goes where. How do we do this? Well, what do we always do? We start with the easy part. So the cash that came in was $2,020,000. So that's going to be our debit to cash, and that comes from the bond price at 101. So that's how we know that the $2,020,000 is what we got in. We know that since the bond is the total value of the bond is going to be $1,940,000, but the face value of the bond is $2 million. We know we're going to have a discount, so we can put the bond on the books at face. That's going to be our 2,000 bonds times $1,000 of bonds. The bonds always go on the book at face. And now we can put our discount on the books. If the total value that the market's putting on the bond is $1,940,000 and the face value is $2 million, then we know that the discount has to be the difference. That's the $59,216. And here we have paid-in capital for warrants, and that's the difference, or that's the amount allocated to the warrants. Then we can make sure our debits equal our credits. So our sum of our debits is $2,079,216. Sum of our credits $2,079,216. So that balances out. So what we've done here is we've taken our total cash that we got from the bond price. We've got the face amount of the bond. Those are going to be our easy givens. We also know that the value of the warrants doesn't have a discount or premium attached to it, so we can stick that there as our credit. And then the discount is the bond value, the bond face, minus the allocated value. And for the paid-in capital for warrants, it's the allocated value. So some of them are kind of plug figures, but at the same time, they all make sense for what they are. So that is detachable stock warrants using the proportional method, where we have market values for both of the securities. One more, and then we'll be done. We can also use the incremental method. So here's another example that has essentially the same facts, except we don't know the market price of the warrants. So McIntyre issued 2,000 $1,000 bonds at 101. Each bond was issued one detachable warrant. After issuance, the bonds were selling separately at 98. But the market price of the warrants without the bonds cannot be determined. Use the incremental method to record the issuance of the bond. So here we only have a separate market price of the bond. So what we're going to do there is we're going to take the entire market price of the bonds, and we're going to allocate that to the bonds. And so the bonds are going to be allocated a value of $1,960,000. The total issue price excuse me, $1.01. Total issue price is $2,020,000, just like before. So the value left over for the warrants is going to be $2,020,000 minus $1,960,000, or $60,000. This is based on the market, and this is the residual, and this is the cash issue price. All right, so how are we going to record this in our journal entry? Again, cash is going to be the easy place to go. $2,020,000. We know that's the bond issue price. We know that our bond payable is on the books at 2,000 bonds times $1,000 per bond, or $2 million. So that's face. We also have the discount that we kind of backed into. In this case, we didn't back into the discount by using the cash flows. We backed into it by using the relative values and say our discount, nope, that's not right, equals face minus market. There we go. So our total discount is $40,000, and the paid-in capital for the warrants is going to be $60,000. And so we've got $2,060,000 of debits, $2,060,000 of credits. Our cash is listed at the issue price. The bonds are recorded at face. discount is the face minus the 98 trading value. So basically we're letting the market price the bonds at 98, and then also taking the remainder of the 2,020,020, allocating that to warrants. All right, so what we've done here is recorded conversion of a couple of types of securities, preferred stock and bonds. We've recorded those at book value, and we've recorded the issuance of warrants, both of detachable warrants, both at the proportional method and the incremental method. And that's what we have done to begin chapter 16.